There are a few fallacies or misconceptions in investing that can prove expensive. For example, equity investments will always give you outstanding returns over the long term. And debt investments are safe. Believe it or not, of all of the things that we discuss on this program, debt investing is perhaps the most misunderstood. And that's because explanations tend to get a little technical. This is unfortunate because debt investments are an important component of everybody's portfolio. This is Moneywise on NDTV Profit, and I'm Alex Matthew. And this conversation is going to be a masterclass on how to invest in debt. We'll talk about what happens when interest rates rise and when they fall, why they do so, the opportunities that you can take advantage of, and we'll also talk about risk. 3 types: interest rate risk, credit risk, and reinvestment risks. And finally, we'll talk about the role that debt plays in your portfolio. Joining me today is Mohit Gang, the co-founder and chief executive officer of Moneyfront. Mohit, thanks so much for taking the time. I really like the concept of debt because it helps you understand, if you understand monetary policy, the way that the economy is functioning, how the central bank and in extension other people look at the growth versus inflation dynamics. But this is not meant to be a macro conversation. This is meant to get people to understand how debt works and where it fits in their portfolio. But let's start by giving an overview of why interest rates rise and why interest rates fall, and we'll go from there.
Absolutely. Thank you so much, Alex. Always a pleasure to be on your show. Look, to me, the bond markets, the debt markets, or the interest rates are like the Gangotri and Yamunotri of everything. It is the starting point of everything and anything globally, whether be equities, whether be commodities, whether be any macro cycles, any minutest part of the economy you want to analyze and you want to get deep into it, you have to start right at the top, which is the interest rates in the economy, right? When you have interest rates falling, which is called a benign environment, which is where we have been for last 1 or 2 years globally as well as in India, right? The repo rates in India have fallen down to 5.25, which is almost a historic low, barring the COVID time when we went as low as 4.5. Right, which means we are following a very loose monetary policy. That means RBI is comfortable by keeping the rates low, which means your EMIs, my EMIs, the corporate balance sheets are looking healthy, our EMIs are lesser, we are paying lesser for the loans, raising funds is easier. There is overall a benign environment, right? Liquidity is also decent, surplus, so that's good. That's prompting growth, right? So when your interest rates are low, growth gets a booster. Inflation also goes up because the money supply is abundant, right? So when you have larger pot of money chasing the same amount of produce, then the prices go up in the economy. So inflation shoots up. When
I mean, just as an example of that, for example, if you're talking about cars, I was saying that suddenly the interest rate on a motor loan drops, and anyway you were thinking of purchasing, but then now is an incredible opportunity, discounts are also available, you will go and make that purchase. And just like you, there are several other people who also would tend to do that. And so the car company has to invest more, set up additional capacity. They have to hire more people, jobs go up, people start spending more money. That entire flywheel gets greased and starts moving faster.
Completely. I think very brilliantly put, Alex. And I think that's the growth engine gets a big amount of fillip overall in the economy. And so lower interest rates kind of boosts your growth, which is good for the economy. But inflation can be a menace. If the inflation goes beyond RBI's tolerance limits, then you have the rate cycle going up again, when that's called the tightening cycle. Once the rate cycle tightens.
And how does that happen? If you're talking about the car example, then you're talking about suddenly there's this big demand for cars. What goes into cars? Flat rolled steel, various other components, tires, rubber, etc. All of those prices start going up, and that feeds into your inflation. And the RBI, by the way, at this moment is an inflation targeting central bank.
Absolutely.
And so when it sees inflation tick up, it has to get ahead of the curve and say stop now.
Yes.
And so it has to make things more expensive. It has to dissuade you from consuming. Totally. And so, as a result of which?
Yes. So when the economy heats up, RBI will kind of try and put some brakes onto the economy, which is by tightening the interest rates, as a result of which you will feel some checks and balances on your personal balance sheet also and on the corporate balance sheets also. And economy kind of slows down. So RBI is always in a fine balancing act, not to let it cool off a lot, not to let it become too hot, right? So that's where RBI comes in. Growth versus inflation is the key focus area for all central banks across across the world. And then you add few other dimensions, you check your currency, you check other global factors, how are the US markets reacting and other things. But yes, inflation versus growth is the biggest driver of debt markets.
Okay. Now, we'll get into instruments of debt because ultimately this is where the big confusion starts coming into the picture, right? And from there, we'll talk about institutions that invest in these instruments, and we'll talk about how individuals can invest into these instruments as well. But if you were to define the playing field, so to speak, of instruments in debt, what would you talk about?
Okay. Before we get onto the playing field, I'll just give three broad pillars of how do you make money in debt, and then we get onto the instruments of debt. There are three strategies to make money in debt, Alex. Accrual, credit, and duration. The debt world is an interplay of all these three strategies, or is a standalone play of any or one of these strategies.
So break it down, explain all three.
Right. So accrual means I'm just banking on the coupon rate or the interest rate. So my fixed deposits are the prime example of accrual strategies. I give my money to a bank, and bank in turn gives me a fixed component of interest, 6 monthly, yearly, whatever be the tenor, and that's accrual yield for me. So that's a defined yield. I hold my FD, I make the yield, there is no other risk in it. And there is a little bit of a credit risk involved out here, but typically you do it with banks or high quality institutes, so that's kind of taken care of. So that's accrual. The second strategy is credit, which is instead of taking a deposit from a bank, I go to a AAA corporate and I say I'm okay holding a bond of an REC or an NHAI or PFC or any other, but I'll get a slightly higher yield. If not AAA, then I go to a AA corporate and I say, okay, I'll go and hold a bond of
We need to explain this because not everybody is going to understand AAA and AA. So if you'll allow me, I'll try and draw a parallel. If I'm somebody who's earning on an ongoing basis, and I want something that I can't necessarily afford at that moment, the options that I have are to wait for a little while or to borrow the money.
Right.
Fair? So if we talk about the car example, I want to buy a car right now. I go to a bank and say, I will pay you an EMI over a period of time. And they say, okay, fair, we'll give you an EMI, but they'll look at my history and they'll give me a rate based on what they think the risk is.
Right.
Similarly, if the car company wants to expand its capacity, it may not necessarily have the money at that moment. So what does it do? It goes into the market and says, give me some funds. I will pay you back at this rate of return.
Right.
And that rate of return is determined based on the risk of a default or a lack of a repayment of that loan. And that is defined by the credit rating that you get, which is AAA being the best rated, AA being lower than that, single A being even lower than that. Triple B is the minimum grade for investments, right?
Yeah. So basically, look, what happens is, again, it's like the CIBIL score for an individual or a CIBIL score for a corporate. So credit rating is virtually your standing or your credit worthiness in the market, basis which you will be lent money in the market, right? So yeah, so you write on that count that typically as you go lower down the ladder of credit, which is you're okay with holding a AA paper or a BBB paper. So today a BBB paper in the economy might currently fetch you around 12 to 14% or interest rate. That's where a lot of retail investors are getting attracted.
Which is mouth-watering.
But equally risky, and we'll come to
risky.
That part.
So therefore, what is the risk? You're talking about, and ultimately, I think we're jumping ahead a little bit, but this credit that you're talking about is because there is a risk involved in the company that you are lending to effectively, not giving your money back.
Absolutely.
They will compensate you by saying, hey, we'll give you a higher rate of interest. Why? Because nobody else is giving them money.
Absolutely. Absolutely.
So that's the point. Right. So you are compensated for taking on this risk. This is credit. We'll get into more details of that in just a bit. And there's a third option, which is interest and duration.
Duration. So third is duration, which is a very basic, simple concept of interest rates, which is the longer the duration, the higher should be the interest rates.
Correct.
Which means either than holding a 1-year paper, I okay with holding a 10-year paper, so I should be compensated higher. If a 1-year paper pays me, let's say 7-odd%, the 10-year paper should pay me 7.5%. So the more you increase the duration, the higher your interest rate is. Duration is extremely sensitive to interest rate movements, right? So when you're saying that you are in a falling interest rate regime, you might just want to play the convexity of the curve and want to go higher duration.
See, now we're getting complicated, Mohit.
No,
So therefore
I'll
you
just
have
try
to
and explain it a little.
Yes.
So
Because convexity of the curve is not something that everyone is going to
I
understand.
get that.
Yeah.
I get it. It just came in naturally. But yeah, all I'm saying is what you do is you buy higher duration papers at that point in time when you anticipate rates to come down, because duration is directly correlated to interest rate fall. Let's say if you hold a 10-year duration paper and the interest rate falls by 1%, there'll be an immediate appreciation in your portfolio by 10%.
But let's spend a little time to understand this in some more detail. And let's take an example. If we're talking about a government bond, Mohit, it's going at what, 6.7% right now for a 10-year paper?
Absolutely.
And when we're talking about a paper here, we're talking about a bond, right? So anything more than 1 year is government bond.
Right.
Anything less than 1 year issued by a government is called a T-bill.
T-bill.
If it's less than 1 year for a company, it's called either commercial paper
or a CD.
Or if it's a bank, it's called a certificate of deposit.
Right.
So let's assume, hypothetically, I've bought a government bond today at 6.7% yield. That is, I'll get that every year for 10 years. 1 month, 2 months down the line, when the RBI meets again, let's hypothetically assume that the inflation has gone up and the RBI says, I want to curb this. So it raises interest rates by 50 basis points. That's half a percentage point. So you, Mohit, are in the market then to buy a government bond. You will get 50 basis points more than I got.
Yes.
Which is, if I bought at 6.7, you get at 7.2.
Right.
In that scenario, both of these bonds are traded on the markets,
Right.
in the secondary markets. What happens to my bond? What happens to your bond?
So the previous bond, which was quoting a yield of around 6.7%, will fall in price because the rates have gone up. When it falls in price, a 100 rupee bond, let's say perhaps might come to a 90 rupee kind of a value. At 90 rupee, that same coupon will exactly match the yield of the new bond. So the yield of the new bond and the coupon of the new bond at 7.2%, the fresh issuance, is same when it comes out in the market, right?
And this is purely mathematical,
This
right?
is pure mathematics. The price will fall to an equilibrium level so that the yields on both the bonds match. So there is no arbitrage per se, whether I am an existing investor or you are a new investor. As a new investor can either buy the old bond because the prices would have fallen from 100 to 92 and you get in a good bargain rate out there.
Yeah.
Or you can go and buy the new bond, basically, which also comes to you at the same yield.
And the opposite is also true.
Absolutely.
So I've bought today at 6.7 and if the RBI, instead of raising interest rates,
To reduce the rate.
cuts interest rates by 50 basis points, it goes to 4.75% on the repo rate.
Yeah.
And so the 6.7 that I'm buying today goes down to 6.2%.
Yes,
And what
absolutely.
happens is
My prices go up.
Yeah, because my bond, the bond that I'm holding, becomes that much more attractive.
Yes.
Is yielding more than everything else in the market. So you, as a potential buyer, would be willing to spend a little bit more to buy this.
Right.
And so therefore I benefit, I book the profit equally. So therefore you can make a loss and you can make a profit.
Absolutely.
in a company. So
Yeah.
you talked about three different
strategies.
types.
Duration can be a tricky strategy if you standalone play that, right? So you have to always do a mix and match of all these strategies. That is where debt mutual funds come into play, Alex. And that's why we say that better than a standalone bond, go with a mutual fund, because they are kind of mixing and matching all these strategies. Somewhere they are playing the middle of the curve, which is 2 to 5 year thing. Somewhere they are playing the corporate bond segment when they see the spread between the government and the corporate bonds increasing. Somewhere they are increasing the duration when they think the likelihood of rate reduction is there.
Very important point, but I want to come back to that in just a bit. Before we do, I want to talk about the risk. And you've kind of alluded to that
Yeah.
when we talked about these three options.
Yes.
But let's talk about these three risks. As I see it, there is reinvestment risk when you're investing in fixed deposit. There is credit risk and there is duration risk.
Yes.
So do you think at this point, and we kind of explained it, but maybe you can go a little more in detail in the
Absolutely.
mistakes that people are making, because a lot of people are going out and buying bonds because it's available at 11%, 12%, 13%. A lot of corporate bond platforms available.
Absolutely.
How does it work and what are the risks involved?
First things first, Alex. The risk-free rate in the economy has to be assumed at the 10-year bond market yield, right? So the 10-year bond yield, let's say if it's at around 6.7 today, that's your risk-free rate in the economy. Risk-free, you're getting that much for a 10-year government guaranteed paper, right? Anything over that, anyone who's offering you over that is potentially bundling it with some amount of risk. So it cannot be risk-free then, right? So now, let's say instead of a government paper, you go with a AAA government paper, which is an REC NHAI. So you're going down the credit ladder from sovereign to AAA. You potentially get 7.5. So with credit, you're increasing that. You go to AA, you're possibly getting 8, 8.5. You go to single A, you're possibly getting 9.5 to 10. You go to triple B, you're getting today around 11ish odd percent. Again, it can vary. And you go to double B or a single B, you might potentially get around 14% also. But you have to be wary of one thing. Debt is a binary game. It's either in or either out, right? So if a company defaults, and let's say there could be two events which can happen. One is a credit rating downgrade. The moment a rating downgrade happens, your yields will shoot up and the bonds which you're holding will fall in price. So there is a huge mark-to-market impact, right? And if the company defaults, then there is very little recourse I have seen for individual investors that they can actually fight against the institutional might and get the monies back. There have been umpteen number of cases, Alex, in India where the companies have completely defaulted and bondholders or credit holders have just lost their money, right? Right from Yes Bank perps to LVB tier 2 bonds, and then you've had the Island FS crisis, you have had DHFL, you have had the ADAG companies, you have the Syntex, you have the Cafe Coffee Day incidents. So there's been myriad amount of incidents where investors in good credit rated companies have lost money because the credit rating downgrade was continuously happening and you lost a sight on it.
So very interesting, right? Because in this scenario, what we're talking about essentially is something very akin to equity risk. It is not equity risk, it's credit risk.
Yes.
But you have to look at the health of a company.
Absolutely.
You have to look at whether it's going to be able to pay back its loans. And if there is even a semblance of a doubt, there is a doubt that they're not going to be able to do that if they're consistently making losses. Please do not invest in the debt of that company.
Fold your bags and run away from that. Run away immediately. Because debt mein you can't take chances. You can't wait and watch for the scenario to unfold because you will never come to know what is happening inside the company balance sheet, right? So, and plus India has a history of having some opaque balance sheets and promoter-driven companies and so on and so forth. So the lower the credit rating, let's say triple B and lower, in that segment you just can't take chance. At least, ideally you should not go there. If you really want to go for 12-14% kind of a game, then better go for equity. Then better go for equity. There is no point of taking that kind of risk on debt unless you are extremely convinced about a company, the way it is run, and you know something inside out of the company. Otherwise, one should always restrict themselves to around AA plus kind of zone.
Because if you think about it, and I started the conversation today by talking about the fallacies in equity as well. Nobody says that equity will always return something.
Absolutely.
But the past is an indication, not necessarily a guarantee of the future. If you look at the long-term rate returns on even the benchmark Nifty 50, you're talking about 12 plus returns, right? And so therefore, you're investing in the top 50 companies in India, as opposed to that, you're investing in a very small company.
Alex, more than that, equities will always give you an exit. Equities are liquid on the exchange. In debt, if you're holding a bond or if you're holding a paper and tomorrow something happens, you want to go and sell that, there will be no buyer. There will be no buyer of that paper. So what will you do? You'll just keep holding it.
So therefore, let's come to the crux of it. We've described certain things, but what is the role of debt in a portfolio? And we'll talk about then how you should invest in it and what the tax rules are, because that ultimately has been making a difference in the decisions people are making. So it has been said that it can form the backbone or the base of your portfolio. Why is it that?
Look, it's the steady income of your portfolio, right? It's that steady batsman in your team who will, in a 50-over match, keep getting you singles and doubles and keep ticking, keep rotating the strike, right? So it won't, he won't ever go and hit the fours and sixes in your portfolio, but he will never not give you a solid base in the middle overs. So that's the crux of your team. You want regular income. You want an emergency corpus. You want something for your short-term goals. You don't want any heightened volatility in your portfolio. You don't want to take any credit risk. You don't want to lose your principal. There are multiple scenarios where fixed income comes into play. You are a retired person. You don't want to chance your money out there. So there could be multiple scenarios, multiple profiles, different types of financial goals. Protection and preservation of capital. When that's the foremost requirement, you go and find balance in debt.
Okay. But there's also a role for pinch hitters.
Absolutely, there is.
And so therefore, if you leverage the credit risk well, if you don't go too far below, see, just like your example of a cricketer, somebody who has an average of 4 runs, but every so often has managed to score 25. As opposed to that, you go with somebody who's got 20 plus average,
Yeah,
but consistently gets you between 20 and 25, gets it quickly.
absolutely.
Which would you prefer?
Look, so I get the analogy, and in debt, then you might go as well with a barbell strategy,
Right.
which is you load up on the short duration funds, which is the crux and the backbone of your entire portfolio. The short duration, the ultra short term, low durations, money market funds, which will in today's context, which will give you, let's say, around 6.5 to 7.5
Sure.
kind of an accrual yield without taking any credit risk, without playing the duration game. Then you load up some portion of the portfolio to play the duration, right? If you think the rate regime is coming off, or if you think the credit environment is extremely benign, then you perhaps go into the credit funds,
Yeah.
right? So you go, instead of a triple A, you go to double A or the single A paper to bolster your yield out there, and that could be a great strategy. A combination of the two can be a great
So
strategy.
you can actually have a core and a satellite
Absolutely.
allocation even in debt.
You should
That's
have.
what you're saying. You should have.
should have.
And so therefore, the question on how to invest, right? Because you have the option fairly easily to go to individual bonds. You can take that.
Yes.
Just like you invest in individual stocks, plus you invest in equity mutual funds, you can have a small portion of your portfolio which you put towards
Absolutely.
this activity, right?
Absolutely.
So therefore, what should the approach be?
Look, if you're buying individual bonds and individual papers, you should restrict yourself to something which is well researched, well known. So I would say a double A segment,
Okay.
right? Double A and above. Triple A, double A, G6, that's the segment where
And
you
even
restrict
companies.
yourself.
You can have companies that are AA rated, which are pretty decent.
Completely. Or you have corporate deposits, let's say.
Yeah.
Let's say in spite of doing a bank deposit, I might just want to do a corporate deposit of a
Yeah.
well-known NBFC, which
Yeah.
will still give me a 50, 70 bips kicker over my corporate deposit, right? So
Fantastic.
that's the main part. The main part, Alex, will also constitute government schemes,
Yeah.
like your SCSS or your Sukanya Samriddhi or your
Sure.
PPFs and other things. So that's the core part of your debt portfolio. The satellite part, if you're following a barbell strategy, can either be duration or can be credit. Very rarely would you find a combination of the two playing out in the economy. So
Yeah.
today, I think the interest rate scenario is extremely benign. You might rather play a credit strategy.
Yeah, because investing in a long paper right now is completely ludicrous because
Absolutely.
at some point over the next 3 years, it could change.
I think it might just change pretty quickly because we have been over a very long period of a low interest rate regime, right? So if you see the 10-year bond yield movements, last year they were somewhere in the range of around seven kind of, they touched almost 7 kind of levels, and then they've fallen dramatically, and they've again risen back for last 3-6 odd months, right? And plus it is also somewhat linked to the global factor. So if US were not to reduce rates, then there's very little scope for India to further reduce rates.
But the ultimate decision that people are making off late is because of the tax treatment, right? And
Yes.
fixed income mutual funds, irrespective of what type of gains you make capital gains or interest rates, it's treated as slab rate,
Yes,
right?
yes.
If you're investing in bonds, however, there is not the same treatment. You can make capital gains which are taxed at capital gains tax.
Yeah, so there is a
Long-term.
finer difference out there. For mutual funds, FDs, bonds, whatever interest income you get, it's taxed at your marginal rate. But if you're investing in a zero coupon bond where the price is the only thing which changes, you buy at a discount and then it matures at the par value, then after 1 year it is treated as capital gains, which is 12.5%, right? So there is a differentiation. The yields obviously will give you everything out. So ZCB of 10-year REC today in the market is quoted at around 6.77, 6.78. And fully taxable REC bond will be quoted at around 7.5, 775 perhaps,
Sure.
right? So that's the way it is.
So therefore, should you make your decisions based on the tax treatment or should it not matter to
Oh,
you?
absolutely. Debt is one way, a game of yields as to what the yield you're making. Second leg is taxation. What is the post-tax in-hand return? That's the most important and the critical component. That's the reason why people, investors have moved away from debt funds to arbitrage funds, just because the arbitrage on taxation was pretty high, right? And third way is a game of credit and duration.
And so therefore, you could also consider investing in debt through hybrid funds, which afford you a little bit of equity, but also a slice of debt which you want in your portfolio. A lot of people are doing that as well.
A lot of people do that, and I think that's more a taxation game than anything. As a portfolio approach, I am not a big fan of mixing and matching too many instruments, but yeah, because it gives you a tax advantage, a formidable tax advantage, then for your fixed income portfolio, you might want to get an equity savings fund, which just has a 15% equity touch. remaining portion in arbitrage, and then in debt, right?
Do you think there's still a strong case to be made to invest in credit risk funds?
I think in the current context, yes, it's a game worth playing, because my sense is we are running a good, longish, benign interest rate regime for next 1 or 2 years, at least a year, year and a half. I think credit could be a good play.
I think it's been a fascinating conversation, and I hope that we've simplified things so that people understand debt better. It's a great thing to add to your portfolio. Mohit, thanks so much for taking the time.
My pleasure, Alex, always.
You've to let us know, was this useful to you? Are you able to understand debt better? And are there concepts that you'd like us to take up in future episodes? Let us know in the comment section and stay tuned. This is NDTV Profit.